Hello everyone, it's Professor Reiko here. Today we're going to be covering our last video in the current liability and contingency chapter, and this deals with asset retirement obligations. All right, so I break this video out separately because in your KESO book it actually falls into this chapter, but if you're using the Spiceland book for your intermediate class, you're going to find that it's going to be in your chapters with your assets, and so I broke it out into a separate video so it can kind of stand alone depending on what book you're using. All right, so what is an asset retirement obligation? Okay, it's just basically we have an obligation sometimes to clean up or remove or restore something at the end of using an asset. Okay, so if we read here, it just says a legal obligation associated with the retirement of a long-lived asset that can be reasonably estimated. All right, so how do we account for this? All right, so we're going to record it at fair value, all right, at what it would take to settle. So fair value, you could calculate that, but a lot of times when we're doing these shorter problems, it will just give you the fair value. All right, so the fair value of what it would take to settle the obligation. All right, and here's what the journal entry: debit to the related asset and a credit to the ARO, which is the liability. Okay, so a lot of times, anyway, when I teach, and probably similar to maybe how your professor does it, we typically define and tell you how to do something, and then we'll do an example. So when we do this, notice this part right here. This is what we're going to see in our journal entries when we get going. All right, and then we're going to allocate the expense over the asset's useful life, so meaning we're going to depreciate it with the asset, and then we're going to accrue interest each period, and what we're going to find is this is going to increase the value of the ARO up to from its fair value at the time up to what we expect it to be in the future. Okay, so let's put some numbers to this and make some sense out of it. So we've got a company. They're putting an oil platform into use January 1st, 2017. Cost of $5 million. So that's the cost of the oil platform. That's the long-lived asset that we're dealing with. All right, here's the next couple sentences deal with the obligation. They're legally required to remove the platform at the end of a 10-year useful life. Okay, so the cost 10 years from now is $500,000. The fair value is $200,000. So we kind of need to keep all that straight here. So let's do the journal entries. So first things first, we have to record the asset. So this is the asset by itself. This is not the obligation. Now let's just assume we paid cash for that. So that gets our asset into use. Okay, and now read this up where I put this star up here. It says for the obligation, we're going to debit the related asset. Okay, well, let's debit the related asset and credit the ARO. Okay, and so remember, we are going to do that at the, it says at the fair value, or the fair value is $200,000. All right, so once again, if you go back in your fixed asset chapter, you talk, a lot of times the cost to restore or an asset, things like that, gets added into the cost basis. Okay, so by doing these two debits to oil platform, this second $200,000 is getting added into that cost basis of our fixed asset. All right, so then we would have depreciation each period. So this, we're just doing 1 year here. So we'd have depreciation expense and accumulated depreciation. All right, so we have $5.2 million into the asset. All right, and so over a 10-year life, that'll just be $520 per year. Okay, now we're assuming no salvage and straight line. And be careful here. Sometimes your teacher may just want the depreciation for the this portion of it. If so, then it'd be $20,000 per year. But I mean, it goes into the cost basis of the asset, so it makes sense to depreciate the whole thing. All right, and the next part. So if you look back up here, we've done this debit to the related asset and credit to the liability, and then we've allocated the expense over the asset's useful life. That's the depreciation. So all that we have left is this part to accrue the interest. Okay, so each period, and notice it says straight line or effective interest, and I didn't outline it here, so we're not even going to put numbers to it. But your entry, the debit interest expense and credit the ARO. All right, so if this was straight line, we could do it that way, or just however the case may be. But I'm less concerned with that. All right, and so what's happening here? Here's kind of the main point. All right, so if we take our ARO, our obligation, It starts at 200,000. Okay, and let's just put a number here. Let's just say this is 50,000. Okay, it doesn't matter. It would matter if you're working a complete problem out and you had all the interest rates and stuff like that to do effective interest, which we don't have in this problem. All right, so notice this 50,000 goes right here. Okay, and so now see how this obligation balance has increased. What we're going to find over the life of the asset is that this is going to keep increasing. All right, and so eventually at the end here, it's going to be 500,000. Which is the cost. Okay, and so let me scroll down here a little bit. I've got my page off just a little. So at the end, our obligation will keep doing this journal entry right here every year. Our obligation will end up being 500,000. All right, and then at the end, let's just assume we pay cash to have it removed. All right, so this will be in the future. We'll take the AR off the books. I'm sorry, the ARO off the books at 500,000, okay, which would make this, all right, so that means it would now be zero because we have a credit balance over here of 500,000. If we debit it for 500,000, it would now be zero. And let's just assume we paid cash to have it removed. We would do that at the end of the 10 years. Okay, so this one's a little bit different. Sometimes this gives students trouble because it's just seems like a little bit different than everything else. But the main thing to remember is, kind of break things up in steps. All right, so these two journal entries right here we do right at the beginning. We're just putting the cost of the obligation into the asset. Depreciation is done every year. Interest expense is done every year. So these two entries right here will be done every year for the 10 years. And what we're finding is over here, this ARO balance is increasing up to what we expected it to be, okay, and then we can remove that cost. Now let's say it cost us this number right here. Let's say that was 510,000, meaning it cost us more than what we expected. All right, so I'm just going to do this right here. So let's say that's 510. We would clearly need another 10,000 there, and that would just be some sort of loss account, okay, because it cost more than what we expected. All right, so that's another way to think about it. I'm not sure how in depth you will get to this in your class, and your professor actually might even skip asset retirement obligations altogether. But here just gives you an example in case you need to work through a problem. Hopefully this can kind of help you out, especially if this is covered in multiple choice. You can kind of reason through things by looking at these journal entries, and hopefully it'll help you out a little bit. All right, so this finishes our chapter on current liabilities and contingencies. Our next chapter, if you're following the KESO book, well, actually, if you're following either book, will be your long-term liabilities, and mainly we'll focus on bonds and how to record those. And then if you've done the investment chapter already, it's kind of the mirror image of that. But we'll talk about that next time. Hopefully you're enjoying these. Please subscribe and share with your friends, and I'll see you next time. Thanks.